Marc from ADM Investor Services International, with a look at some of the major EM countries this week, contrasting two on the one hand, which are major importers of oil, that's India and Turkey, with Brazil and Russia. Particularly the latter two are obviously big oil exporters, but also are taking interest rates down to record levels not seen ever before and ever. In fact, I think in most people's minds, no one ever contemplated that they could actually get interest rates down to these sort of levels. So my first chart is the Russian ruble against the dollar. As one can see, it took an enormous hit back in March as oil prices tumbled in response to the expected sharp fall in demand in oil, getting as high as 80 versus the dollar. And apart from the hiatus around the big collapse in oil prices at the end of April, it has been steadily recovering. So how does it compare with some of the other countries I've mentioned? Next table is one of FX performance versus the dollar for the four currencies of those countries. As one can see, the ruble has of late been the stellar performer over the last month. In fact, the last 3 months, it's gained about 15.8%, while the others are still registering losses for that particular time period. All of them are obviously down quite sharply versus the dollar, relatively speaking, with perhaps the exception of the Indian rupee, which is only down 6%. So what's been happening in terms of central bank interest rates in those countries? And I think that's actually quite instructive. I've had to break the charts into different sections simply because it's very difficult to put charts of Turkish interest rates and 5-year yields on the same chart without rendering it meaningless as Brazil, India, and Russia. So the first table is to show just how interest rates have fallen in the three countries. As one can see, Brazil has cut rates this week down to a record low of 2.25%, really quite remarkable. I never personally ever thought they'd be able to get rates much below 4% under any circumstances, even the current emergency. In Russia, I've got a 100 basis point rate cut there for today on the day that they're coming to their decision, which is the expectations, which would take them down to 4.5. And in India, one can see that interest rates have fallen steadily, but not nearly as emphatically as elsewhere. The interesting aspect in all of this is how we've seen differing performances in terms of long-term government bond yields. So the fourth chart today is of Turkish rates versus their 5-year yields, which will be also the comparator for the others on the final chart. As one can see there, and I think this is very instructive, as much as we've seen dramatic cuts from the very high levels due to raging inflation, currency collapse, and political tensions in Turkey. We've seen rates come down to 8.25%. They're expected to fall to 8%, but they're gradually running out of road. And there's a good reason for that. Turkish inflation remains at 11.4%. And to a certain extent, the high level of inflation reflects why we've got all that risk premium factored into the 5-year yield there. My final chart is of the 5-year yields for Brazil, India, and Russia. And I think the interesting aspect of this is how at the start of the period a year ago, Russian yields were so much higher than the others and now are seen much, much, much further below. And that probably explains why the central bank in Russia wants to basically cut rates so dramatically today to try and avoid some of the carry trades which have gone into it. It also reflects the fact that inflation in all of those countries is a good deal lower, particularly Russia and Brazil, than in Turkey, though in India we would have to add that we haven't actually had any official inflation data since the March report, where it stood at 5.9%. It's probably a good deal higher now, given food prices are at 9.3%. Any case, something to think about for this week.